Welcome to the Jill on Money Show. It's Monday, August 5th, and we are here trying to help you make better financial decisions. If there's something going on in your life and you need some assistance, just give us a holler. Go to JillOnMoney.com, click the Contact Us button, and if you write us a note, that's the email we receive. Give us a lot of detail. If you would like to join us live, check the box, and Mark, the best executive producer in the world, will do everything else because he does that. He also puts together the free weekly newsletter, which comes out every Friday and kind of gets you caught up on some stories you may have missed during the week. So sign up for the free weekly newsletter right on the front door of our website. Now, for some of you longtime listeners, you may remember that way back during COVID, we would talk a lot about markets every single day because things were moving around so quickly. And we haven't done that in a while until last week. Last Monday, I came and popped into your ear and I wanted to tell you a little bit about what was going on, whether it was about inflation or the economy. And here I am again on a Monday, just trying to get you caught up on the breaking news of last week, but more importantly, to give it some context. Because I think there's always the headline, there's the information, but the real question is, how does this impact you? In the last couple of weeks, we have been getting some information that feels a little bit sometimes scary, I think. So let's go through some of that. We did get an economic report that showed that growth in the second quarter was stronger than expected. But then all of a sudden, we started to get other more timely reports that really started to indicate that maybe the economy was slowing down. And there was some thought that perhaps when the Federal Reserve met in the two-day meeting for July, that perhaps, maybe, they would lower interest rates. Now, most of the folks who watch the Fed did not believe that that could happen because, honestly, this is a Fed that loves to telegraph what it's going to do. And they were never going to do that. So they just were going to sit on their hands, do nothing. But then 2 days after the Federal Reserve met, we did get a jobs report. And that jobs report was weaker than expected. So I think it's important for us to just sort of take some of this information in because the markets digested that information very quickly and we saw a drop in stocks. You know, the stocks were down anywhere from 1.5% to 2.5%. And the NASDAQ is now officially in correction territory. But that's a lot of information for you to take in. So first, what I want to do before we talk about you and what's going on, let's get through the information. I went on CBS Saturday Morning with Jeff Glor and Michelle Miller to dive into some of the numbers. And on the other side of that segment, I want to talk about what I think you need to know as you're managing your portfolio. So here's the segment from CBS Saturday Morning.
Economists thought there'd be 185,000 jobs. How surprised are you by this, and what else stood out?
Well, I think it was a surprise miss, but we have been seeing these revisions lower to previous reports. There has been some chatter about the labor market softening. I think what really stood out to me was that unemployment rate that you mentioned in the intro. That rate being up 4 consecutive months is kind of a bad omen. Going back to 1960, when we have consecutive increases in the unemployment rate for 4 months, we see a recession. Okay, don't go crazy. I'm not saying there's going to be a recession, but we do have to at least put it out there. Also, we saw wage growth come down to 3.6% from a year ago. That's still ahead of the inflation rate. But again, it's a big drop from 3.9% in the previous month. So I think taken together, we have to say this is a report that's indicating that there is some tapering off in the labor market. It's not like the, oh, my God, DEFCON 4 or 1. I'm not sure which one it is.
I always forget which
one is it. I'm not sure. But it is a warning sign.
Okay.
Well, so this comes 2 days after the Fed took no action on interest rates. Was that a mistake? And what's the next step?
Well, I think the Fed's in the spotlight because I think there are a lot of economists who think that was a mistake. They say, hey, look, you told us that all you needed to see was the inflation rate coming down, and you also wanted to make sure that wage growth was coming down so that consumers were not fueling inflation. Meanwhile, they didn't do anything. But what this does mean is that that September meeting becomes incredibly important because now, while the Fed could cut rates in between meetings, they often don't. unless there's an emergency. This could mean that the first rate cut is not 1/4 of a percentage point, but 1/2 of a percentage point. And right now, if you look at the markets, the sort of the betting markets in the bond market, they think the Fed will cut rates by 1 full percentage point by the end of the year.
The markets have been riding high for so long, and everybody keeps wondering. Also, the recession, you just mentioned recession. I mean, I feel like we've been talking about this for years now, right?
Yes.
You're here 2 years ago. Is a recession coming? You just mentioned it again. We don't know.
We don't know. However, recessions are part of the normal business cycle. And so what are investors selling stocks for? Because they say, wait, if the economy is softening, if that means that things are deteriorating, if the labor market is turning over, then people aren't going to be able to spend as much money and companies won't earn as much money. Let's sell stocks precisely for that reason, Jeff, that in effect, if you've made so much money in the last 18, 19 months, why not take some money off the table? I will say this about recessions. I know that we hate them, but they're not all the same flavor. You can have shallow recessions, you can have deep recessions. So to be clear, if you're an investor, please don't do anything. Take no action. Stick to your game plan, especially if you're a long-term investor. This is noise.
Okay, I plowed through a lot of data in that segment. But I think the central question boils down to, did the Federal Reserve miss its opportunity to engineer a soft landing? We don't know yet. We don't know yet. I think that the reality is most economists believed that when the Fed was late in raising interest rates to combat inflation, that they had to push them so high and keep them there for so long that we were going to risk a recession. Now, the much feared recession never actually materialized. We thought it was going to be in 2023, and it wasn't. And we thought it was maybe even going to slow down in 2024. But for the first half of the year, growth has been a little over 2%. So it is possible that the Fed did, in fact, keep rates too high for too long and that we are headed towards a recession or even just an economic slowdown. But does that mean you need to do anything with the money that you have invested for the long term? I don't think so. I really don't. You know, even with the sell-off last week, we see that the Nasdaq and the S&P 500, they're ahead by about 12%. Dow's up about 5.5%. We know that big tech valuations got knocked down, but big deal. And frankly, if you are looking at your portfolio for the next 10, 20, 30 years, trying to figure out how to manipulate that portfolio is a pretty dangerous game. If you really believe that a slowdown is coming, here are some ideas to consider. Number one, why don't you stockpile a little bit of extra money in your emergency reserve fund? I think this is very important, especially for people who are approaching retirement. Maybe you got in touch with us and said, I'm going to call it quits at the end of the calendar year. If that's the case, I would rather have a little bit more cash on hand, more like 1 to 2 years of your expenses, less whatever income is coming in, rather than 6 months to 12 months. The other thing you could start to do is think about maybe holding off on big spends. Now, it doesn't mean you shouldn't buy your house. Maybe you've got that all set and ready to go. But it may mean that instead of taking a huge round-the-world trip to start your retirement, that you might go with something a little bit smaller. The thing that we know about people who either graduate into a recession or retire into a recession is that recession can actually do a number on your planning or your income for probably about 10 years. So I want you to be careful if that's happening right now. And the other thing that I would suggest is be clear about whether or not you really do want to make a big change like retirement or even a new job right now. Because if we are headed into a slowdown or a recession, sometimes what can occur is the person who is the last in is the first out. Beyond that, if you've got a real concern about what you think is going on in the economy or how it might impact your plans, we invite you to get in touch with us. Go to our website, JillOnMoney.com. click the Contact Us button and let us know if you would like to join us on the air live. While you're on the website, check out all the content that lives there. We are always happy to present you with lots of fun opportunities on that website and even a chance to spend a little bit of money. Check out the service Jill on Money Live, where you have access to quarterly live webinars and bonus video content, all for $35 for a 12-month period. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. Please leave us a rating and review wherever you listen. To start the week off, guess what? We're going to ask you to do something really nice for someone else today. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you tomorrow.